Hello and welcome everyone. Today we are going to talk about monetary base, money supply, money multiplier, and the objective of monetary policy. So we will be going into the specifics of these things, which generally the central banks of a country deals with. So we will start with the outline. So the outline of this discussion is to have an idea about the monetary base and the money supply, the money multiplier, how the money goes multiplied in the economy, and we will be discussing over what are the factors that impact the money multiplication in the economy, who controls that and all. And finally, we will have a discussion bit on monetary policy objectives. So that is broadly the agenda for this discussion. So we'll start. So first we are going to start with the monetary base. So this is also called the high powered money or the base money, which serves as a base for creation of money in a economy. So this is monetary base and called as high powered money and mentioned as H. So let's start with the definition of this. So monetary base is the total money created directly by the central bank. So here we need to focus on directly controlled by the central bank. So the money which is directly in the control of central bank, no other agency, no other institution have any say in that, that is called as monetary base money, or the high powered money. It forms the foundation of the money supply in the economy. So in the due course we will be discussing what is the money supply, but here we need to keep in mind that the money supply happens on this monetary base or the base money, known as high powered money. Let's discuss the formula for this monetary base. So monetary base is made of two components, that is C plus R. C is the currency with the public or in the circulation, or currency in the circulation in the economy. So that is the C, and R stands for the reserves. So reserves means the money kept by the banks with the central banks, or we call that reserves of commercial banks with the central banks, because the commercial banks impose some restrictions over the banks that they need to maintain certain amount of reserves with the central bank. So that is the reserves here we are talking about. So here important thing is that the monetary base is made of these two components, that is currency with the public or currency in the circulation in the economy, and the reserves of the commercial banks with the central bank. So this constitutes the high powered money. So let's discuss a bit further about the components of monetary base or the base money. That currency in circulation, C, includes note and coins held by the public, and they are used for daily transaction, day-to-day transactions, and it is in the control of the central bank. The other component is the reserves. That reserves include the cash held by the commercial banks. Here few things we need to keep in mind, that when we are discussing the reserves are decided by the central bank of the nation, of a country. In case of India, the RBI decides the reserves, how much reserves the banks has to keep with the central banks or with themselves, and a deposit with the central banks, and includes reserves, required reserves, and extra reserves or excess reserves. So excess reserves are those reserves which the commercial banks have or maintain, apart from whatever the statutory guidelines are there from the central bank's side. Okay, so those are the excess reserves maintained by the central banks, by the commercial banks, sorry. So why is it called the high powered money? That you might be thinking of. We are calling that this is the money which is created by the central bank is the high powered money. The reason being it is called the high powered money is that it is the base on which the ultimate money supply in the economy, or the volume of the money supply, will be impacted at the end. So whatever the money is created by the central bank directly, that is high powered money, and over that it is multiplied, and we are going to discuss the process that how it is multiplied. Then we reach out the total money supply in the economy. So the few of the reasons why it is called high power, that a small change in monetary base leads to a large change in money supply. So here a few things we need to take into account, specifically that monetary base or the high powered money must be lower than the money supply in the economy. So money supply is the result, or depends upon how much monetary base is, or what is the monetary base. Based on that, we will reach at a figure which will represent that what is the aggregate money supply in the economy. The other thing is that it is directly controlled by the central bank. There is no other intervention in creation of money supply. So in that case, central bank is the monopolist in creating the base money, and it acts as a raw material for money creation. That is very important, that this base money is used or can be regarded as a raw material which is later on used for the credit creation, a process through which the money is circulated in the economy time and again. We call that process the credit creation, that leads to a certain level of money supply in the economy. So central bank control over the monetary base. The central banks, how the central bank is going to control the monetary base. So it controls the monetary base through open market operations by buying and selling the securities in the open market. And through that it impacts the high powered money in the economy. And then through the repo and reverse repo operations, by changing the rates of repo and reverse repos in the monetary policy, they impacts the monetary base or the high powered money. Similarly, they changes the reserve requirement like statutory reserves, or like SLR and CRR in case of India. So those requirements are changed, and based on that the monetary base is changed. And lending to commercial banks. So by lending to the commercial banks also, the central banks changes the monetary base. So these are the components that impacts the monetary base. So next thing is, now we have discussed the high powered money. Now let's discuss very important concept, that is money supply. So money supply is what? Money supply refers to the total stock of money available in the economy. It includes currency and various types of bank deposits. So it is talking about various types of deposits also happening in the banks, or are created in the banks. So that's all about the money supply. But let's discuss that if we want to know right now that what is the money supply in the economy, then that is a very important question, that how much money is floating there in the economy. We want to have an idea about that, because later we will be discussing the quantity theory of money, which states that the volume of money, or the how much money is there in the economy, that have direct influence over the inflation or the prices in the economy. So that's what we will be discussing. So that's why we need to understand that how much is the money supply in the economy. So for doing that, there are different measures, or we call them monetary aggregates, that gives us an idea that how much is the money supply in the economy. So there are four measures here which are used to measure the money supply. The first one is the narrow measure, which is known as M1, which includes currency with the public, demand deposit with the banks, and other deposit with the RBI. So these components constitute the M1. So that is the first measure, and is a narrow measure of money because it includes a few set of variables that accounts for how much money is there. The next component is M2, which constitutes M1 plus post office saving deposits. So when we include the M1 and post office savings, we get another measure, that is M2. And the third measure, which is very important and used by the by Indian economy, or in India we use this much, or RBI publishes data on this regularly on broad money, that is M1 plus time deposits with the bank. So how much money is there in the time deposit plus the M1 leads to the M3 measure, or we also call that broad measure of money. And the next is M4, that is M3 plus total post office deposits. So we are adding the post office deposits in the M3 and we reach at M4. So this is the broad structure, that how we measure the money in the economy. We have four measures here, and M3 is the most broadly used measure in case of India. And by using these measures, we can understand that how much money is there in the economy. Now here few things I would emphasize, that this M1, M2, M3 and M4, so these measures differ in the liquidity. That means how easily we can convert that into cash, or how close these indicators or aggregates are close to cash, we can rank based on this. So M1 is more liquid compared to M2, and M2 is more liquid compared to M3, and M3 is more liquid to M4. So if we put liquidity wise, so liquidity goes like this. So M1 is the most liquid and M4 is the most illiquid measure of money supply. So this is important. As we go ahead, we need to understand that different measures of money supply differ in the liquidity, and how these liquidity gives us different measures of assessing the total volume of money supply in the economy. So now we are going to quickly going to discuss the difference between the base money and the money supply. So we will be discussing on few aspects like who issue it, who controls, what is the size and the role of this. So monetary base, this monetary base, as we said, the high powered money is directly controlled by the central bank. But money supply ultimately in the economy is controlled by banks, and public have influence over that. So now why this happens? Because the banks create the banks engage in the credit creation, and that leads to the circulation of money time and again in the economy, and that leads to increase in the money supply. So I will give you one example. Say for example, there is the commercial banks got 100 rupees as a deposit with them. So with that, they will say, for example, the reserve requirement is 10%, then they will keep 10 with themselves, and the rest of the money they can lend out to the general public. Like they will keep 10 rupees out of that, and 90 they can lend to 90 rupees they can lend. Similarly, now this 90 is gone to somebody, say for example somebody took the loan, but ultimately that money is going to get into the banking system itself. So that 90 is there in the banking. Now the banks will once again give this 90 rupees by keeping certain amount of reserve, say for example 10%, so 9 rupees they will keep, and again they will give 81 as a loan. So initially there were only 100 rupees, but this process keep on going, and we end up with more amount of money in the economy with the same amount. So let's think it from the base money's point of view. If the central bank RBI is creating 100 rupees, then the commercial banks are multiplying this currency in the economy through the process of advancing the loans or giving the credits, and this money keeps on increasing up to when the whole amount is exhausted. So total amount, so if we sum up with this will end up having certain value which will be obviously greater than the monetary base. So who controls this? It is directly controlled by the central banks, and it is not directly controlled by the central banks, although it is indirectly controlled by the central banks through setting the reserve requirements or through other ways. Then size, obviously the as I discussed, this is the monetary base, so the base is going to be smaller, and the ultimate money supply, if we sum these all the variables up, we will get a higher number or larger number, so it is larger. And the role is, it is just foundation, it creates a foundation which, on the basis of which the banks create the money in the economy or increase the money supply. So it plays a role of foundation, and it is the final stock of money, the ultimate number or ultimate amount which is created in the economy.